You can be wrong 60% of the time and still be highly profitable in the markets. Success in trading is a matter of strict mathematics, not fortune-telling. Tom Bierovic learned this early. As a teenager, he drew price charts by hand for his father, a trader at the Mid-America Exchange. Watching the chaos on the trading floor taught him that surviving an environment driven by raw emotion required strict, emotionless rules. This chart is the foundation of the Bierovic system. On a 15-minute time frame, a 10-period simple moving average smooths the noise to define the trend. It creates a binary rule. Above the line, you only buy. Below it, you only sell. By establishing this absolute boundary, the trader eliminates guesswork. You no longer have to decide what direction the market is going. The system makes that decision for you, instantly curing the emotional paralysis that destroys novice traders. But we don't initiate a trade simply because the price crosses a line. We have to wait for the market to retreat slightly, a setup known as a pullback, before entering the position. This interface translates visual intuition into strict algorithmic logic. We define the moving average, the pullback condition, and the execution command. Then, Bierovic enforces a 2-to-1 reward-to-risk ratio. For every dollar risked on a stop-loss, the profit target is exactly $2. This exact ratio is a mathematical necessity. If you design a system that only wins 40% of the time, your winning trades must be strictly bound to pay out double your risk. That math is what keeps the system profitable. Building a mechanical strategy is an exercise in risk architecture. Reading the chart is secondary to structuring the payout. This chart shows a back-tested equity curve. The overall trajectory is upward, despite frequent sharp drawdowns. Those dips represent the 60% loss rate. You lose more often than you win, but the 2-to-1 reward ratio continuously pulls the curve to new highs. Let's test this. Price is above the moving average, but suddenly forms a massive downward drop. Do we sell? No, we never sell above the moving average. That bearish candle is a trap to shake out emotional traders before the trend continues. By treating this as a mechanical problem rather than a predictive one, the code acts as a cognitive shield against visual manipulation and fear. Theoretical math shatters in the real world due to slippage, the difference between the price you want and the price you actually get. Bierovic neutralizes this by filtering strictly for massive, highly liquid electronic markets like the S&P 500 or Treasury bonds. If you attempt to trade thin, illiquid markets like orange juice or lumber, a sudden price gap will blow past your stop-loss. When you cannot guarantee your exit price, you break the 2-to-1 ratio and the math fails. This checklist shows the Bierovic system distilled into 4 actionable steps. 1. The 10-period moving average dictates your allowed direction. 2. Wait for a pullback to enter. 3. Enforce a strict 2-to-1 reward-to-risk ratio. 4. Expect a 40% win rate. Systematic trading demands that you abandon the illusion of predicting the future perfectly. You trade perfection for the mathematical certainty of probability.